Morning, YouTube. I wanted to talk a little bit about the federal interest rate increases today, and kind of what to expect and what that affects. Maybe you can use this thinking for some of your planning for your investments, for your debt to income ratios and things like that. So let's get right into it. I wanted to show you some historical perspective. Interest rates right now are close to 0%, the Fed rate at least, and that's the government rate, lending rate to banks. And you see historically it's been a lot higher, but back in 2000, right before COVID hit, you had 2 point something percent interest, and they're expecting 7 rate increases, which puts you at about 2% interest. It looks like they're going to go back up this curve to about this number. And what that affects is first the cause. The cause of the interest rate increases is the federal government. They're the only ones that can change the Fed rate, which is where most of your money actually comes from. And there's no other cause to interest rates increasing at the core. The correlation might not be, day one they change the interest rate, and day one everything that you have changes, but they change the interest rate, then everything else has to react to that interest rate change, and then you see the effect. And so you want to make sure you correlate, the actual cause to the effect that you see, or that maybe you're pricing into your investments, so that you can make wise decisions. I see it go up. I know it's going to happen. Here's what's going to happen to my assets. Here's where I should put my money. So the first effect is people are going to qualify for lower loans. When you go to borrow for a house at 3%, you qualify for one loan amount. And when you borrow at 4%, you qualify for a lower loan amount based on that payment compared to your income. And so that can have some effects of average loan prices, average house sale prices being lower, but it's hard to say what the net effect is going to be when it starts out. But it just means there's going to be less qualified people going for the same properties, which will probably end some of these bubbles in demand where there's bidding wars for houses. Increased cost of revolving debt. If you have credit card debt, that cost will increase some. More home equity loans will increase proportionally to the increase in rate and debt like that. Credit card rates a lot of times are very high credit card debt anyway because of the actual risk of default on the debt, not so much the underlying interest rate risk. Increased business costs. Most businesses have debt. They use that to leverage what they're doing to fund projects and things like that. So you'll see less projects. You'll see less money from business chasing after assets and other businesses because the cost of those will increase. And you'll also see them having to pass some of those price increases along to cover those additional debt costs for, a business that might have debt in the business model, such as, rentals have debt in the business model. They may have to pass those costs along to renters. Secondary effects of higher interest rates. Overall house sale prices can lower. There's less money chasing it. People qualify for lower loans. Business projects can be canceled. Debt-sensitive prices are increasing. Higher minimum payment and lower consumer spending. So your monthly payment minimum on a credit card would increase if the rate paid on that money then increases. So that would maybe decrease people's spending over a period of time. Things that aren't causes, corporations are not causes of this. The corporations are going to charge, like for a credit card, the highest rate that they can, competitive to the market, and that's not going to change in this situation. They're going to do the same methodology, so they're more of a reaction to this. Individuals don't cause this issue. This is purely caused by the Fed rate changing, and the government lending rate changing back to what it was, a few years ago. Helps. Houses are more available to qualified buyers. There'll be less people chasing the $250,000 house. There's less people that are qualified for it. The money that maybe someone was going to make a cash offer on that house will be less because there's less people, less demand, less price pressure from demand on products. People won't be buying quite as much, so that pressure on price will move. There will be the other pressure of interest rates in certain areas but that should be a lot less. From an investment standpoint, less money available for real estate investing, and it costs more. So no longer do you have that 7% inflation and 3% money cost, so 4% built in everything you buy. A little bit more careful on what you purchase because there's less money chasing it. On debt obviously costs you more. Companies with debt or cash-rich companies might be helped with low debt, right, versus a competitor. Competitor maybe has 50% debt, payment. Interest rates rise. Now they have 75%, and they're not able to fund the right projects to compete with someone else. And so your cash-rich companies might have an advantage in this environment. Rates of return on crypto will have to compete with rates of return at your bank. And so a lot of money flowed into crypto, especially stablecoin, for the higher interest rates because your bank was paying nothing. So if your bank starts paying more, some money might flow back out of stablecoin. So that might be an effect. And lastly, people who have savings in the bank, there'll be a decreased loss of value. It'll still go down in value with inflation, but you might get instead of 0% interest rate, you might get 1% interest rate or 2%, and versus 6% inflation. So you're now at 4% loss per year as opposed to 7 before. So that might decrease your loss of money that you have in a savings account. I just wanted to give you a little rundown of kind of what this looks like and some things that might be affected. And I'll be tracking and kind of looking at what the interest rate effects has been over time. And I'll let you know how that affects what I invest in, how I balance debt to cash, and how much that affects crypto and when I invest in crypto. I'll talk to you guys later. Bye.